Hi, everyone. Welcome to another week of Psychology of Money at Northern Kentucky University. I'm really excited to once again have two guests with us. Stuart Crickmer and Rob Jung are once again here to talk a little bit about the psychology of money and investing. And this week, we're going to talk more about understanding risk in investing. So thank you both for being here today and taking time to talk to the students. We have a couple of questions and I'll just jump right in here with the first one. So the students have been working on the weekly investment challenge simulation, which is really like fun games that you play that both of you developed to really teach about investing and increase financial literacy. And in this simulation, they get to learn about the power of compound interest. And it's really powerful. And so you can see it in action. But my question maybe for Stuart first is, given that people know this about compound interest, why don't they plan appropriately for retirement? What are the challenges there?
Well, there are a few. I would say, first of all, most people don't know about compounding, and that's part of the problem. Like, this is one of these profoundly magical ingredients to investing, and it's not really a secret, but even when people hear about it, they don't necessarily believe it, which is part of the problem. Because when we're talking about compounding, it's not going in a straight line, it's not linear, it's exponential. And most humans can't really deal with exponential math. It just grows much faster than you can. So for everybody who went through week 4 of the weekly investment challenge in that 40-year simulation, one of the big reasons we did that was to let you experience compounding and see it. So I will say that everybody in real time will eventually experience compounding and they'll understand it. But for most people we run into, if we're working with somebody that's getting closer to retirement, at that point, they kind of get the idea behind compounding and they think, oh, why didn't I know this when I was getting out of college in my 20s? So that's pretty much a universal type of thing. And, part of it is, I was reading something recently talking about how people have a hard time picturing something they've never experienced. So, whatever it happens to be. So you don't experience compounding until you're maybe too late to really benefit from it, which is why we try to do it in simulations, and rather than talk to people about it, let them feel it. The other thing I'll use is an analogy, which is, we'll say investing is like your money going viral. So, sometimes the terminology like compounding sounds, kind of boring, to be honest with you. Mm-hmm. But what we're talking about is nothing different than what you see with social media posts going viral. They start out from 1 person to 2 people to 4 people to 8 people, and then all of a sudden it just kind of blows up. That happens with your money. That's compounding in a cool way. And of course, we've seen, unfortunately, what happens when a virus goes viral. But it's a similar kind of thing. So if you can think of here's a good example of exponential growth working in your favor, that's what it is. But to come back to it, I don't think people are aware of it because they haven't experienced it. And there's one other factor, which is it's really hard to get people to make decisions today that won't impact them for years down the road. So, it's not like it's a super difficult secret. Small amounts of money can grow into insanely large amounts of money. So, part of the challenge is how do you get that to people early enough where they can act on it.
Yeah, and I guess that's true that, it's hard to envision yourself 40 years from now. So, that's part of the challenge too, is that, you don't really know what you're going to be like 40 years from now, but you have to plan for that. So.
Yeah.
Okay, so in this investment challenge, it's fun for the student. The student can pick an avatar of someone that, they want to invest their money, and they get to pick the percentage of stocks and bonds that they're investing for retirement. And in real life, this is called asset allocation, and people find it very confusing. And it's very intimidating, I think, to the new person to investing. So maybe for Rob, can you explain a little bit about what goals should be in mind when you tackle this task, and how do you get started because of the intimidation factor?
Well, first thing is addressing fear. So when you're experiencing something that is unknown the first time, the first reaction for most individuals is a little bit of fear, anxiety associated with that as well. You got to acknowledge that. And once you can acknowledge that, then what you got to do is you got to search out for a little bit of education. None of us just hop on a bike for the first time and ride it. It takes a little bit of practice. It takes a little bit of failure. And then all of a sudden you learn and you develop it. Just like playing golf. I don't know of anyone who picks up a golf club for the first time and shoots par. It just takes time, and it takes practice and experience, and education is probably the biggest thing that I see. So there are some great resources out there on the web that you can search. And what I would do is just start Googling some of the phrases that you're not familiar with and try to put some definition around it. And don't go to one resource. I would probably grab a few different resources so that you get a general understanding that comes together. I think is the most important aspect there. So it's education is the next step. Stuart, is there anything you would add?
Well, I would, in the weekly investment challenge that you guys just did, there was, I think it was week 3 where we introduced not just stocks, but a money market fund and let you kind of see what it's like, side by side. Asset allocation, I mean, this is the simplest example. Stocks and a money market fund are just 2 assets. And if you mix them up, let's say, for example, you put half your money in one and half in the other, that's basically asset allocation. But if you're going to do that, kind of to your point, Rob, about education, like these terms like asset allocation even sound kind of complicated, but all we're talking about is just mixing up a couple different types of investments. But then you got to get to the point that you have to at least understand what's the difference between a stock and a money market fund. So what's your answer, Mr. Jung?
My answer. Stock is actually ownership in a company where you own a portion of it. A company issues X number of shares, you buy Y number of shares. So Y divided by X is a percent that you own of that company. Generally, for us average people, it's a very small percent. Generally, we purchase them through mutual funds and ETFs because it's cheaper and we can get quick diversification. Diversification is owning many different companies in one investment vehicle. Probably the easiest way.
So you're telling me you wouldn't want to have all your money in Boeing, for example?
No, especially after they had trouble over the last year and a half. So probably not a good idea. You probably want to have your money spread out over numerous companies. What that number is depends on you as an individual, what you're comfortable with. Generally speaking, you can start to get most of what they talk about is diversification with about 25 stocks. And then you get to a point where you're not getting much diversification after a certain number. That certain number, depending on the different studies, it's 100. Some of them say a little bit larger.
Okay, I got a follow-up question if I can, Rob. Back when we were starting doing this stuff, if you wanted to be diversified, you had to go out and buy, a bunch of different companies and so forth.
Correct.
Things have changed a bit. You mentioned ETFs. I mean, do you need to go try to research and buy all these stocks, or is it possible to just go, buy an ETF that gives you a diversified exposure to the stock market, for example?
Great question, Stuart. And yes, there's multiple ETFs out there that'll duplicate different indexes that are out there. An index is just a conglomerate or a pulling together of different stocks that represents different marketplaces. So like the S&P 500 is one that's quoted often. That's actually composed of 505 different companies that have different weights inside of the index. I'm sure most of you guys have heard of Amazon, Netflix, some of the other Google. They represent a larger portion of the S&P 500 than other companies. Some other companies that would be in the S&P 500, 3M, P&G, and they're a little bit smaller percent of that representative index. There's the Dow Jones Industrial Index that's made up of 30 different names. Microsoft's in there. Boeing, if I remember, is in there as well, Stuart. And then
I'm sure it is. But and ETF stands for
exchange traded funds.
Okay, yeah. So you can buy in the same way you could go buy a share of P&G, for example, good Cincinnati company,
Mm-hmm.
and it has a ticker symbol PG, right?
Mm-hmm.
You
You're
could go
correct.
search the ticker symbol IVV, and if you buy it, you're basically buying the S&P 500, right?
Correct.
Okay,
100%.
just
That
one
is right.
share, and you've got all the diversification. You don't have to fool around with, picking all the stocks and so forth.
Correct. And
Yeah,
for
that's
the
one
most,
thing that I think is great these days is it's not only is it easy to do, it's less expensive and so forth. So if you kind of have the general idea of stocks, you can instantly get diversification, whether it's through a mutual fund or one of these exchange traded funds you're talking about.
right. You're spot on. And IVV is actually issued by a company called BlackRock, which has iShares, is what they're calling their ETF family of funds. There are multiple companies out there that issue multiple different types of ETFs. Most of them wind up being very duplicative of each other. So what I usually tell people in that scenario, if you got two of the same thing, you want the one that's the cheapest to you to own, which would be an expense ratio.
Okay, so real quick back to asset allocation. Now, on the other extreme, a money market fund, I think the easiest way for somebody to understand it, it's kind of like a glorified savings account. Like you put money in the bank and you get paid interest, and like you're not getting paid a whole lot of interest right now. So real simple question for you. Let's say those were the only two investments you had, a money market fund, and let's say this ETF that represents the S&P 500. And you, Mr. Portfolio Manager, are doing the asset allocation. And let's say you're doing an asset allocation for somebody who's just left college and they've started working for their company. What percentage are you putting in stocks? What percentage are you putting in the money market fund?
Well, Stuart, I would say their time horizon is very long if it's for retirement. And given that scenario, and they've just left college, you're talking at least 40 years to retirement. I would put 100% into the stock ETF. I would put nothing to the money market account. Though if you're looking out just 1 year into the future, the risk would be perceived to be higher for the stock ETF. You got to remember your time horizon for investing is 40 years. And you can handle any of the ups and downs and the ebbs and flows that occur in the stock market, and you're going to get a much greater return, and it'll benefit you long term by having that stock allocation and not having anything allocated to a money market account.
And based on what you just said, then your allocation, which initially is 100% stocks, at some point over time, you change that depending on how close you get to retirement, right?
Correct. Yeah. Yeah. You will scale that back over time. And what I usually like to do is someone starts to come closer to retirement, we'll introduce bonds. Bonds is borrowing. I lent my brother $100. That's a loan. He borrowed money from me. The same thing happens for corporations, and that's called a bond, is how we would look at that. And as you go get closer to retirement, you're going to start to introduce asset classes that have less fluctuation in value. And that way you can lock in, for lack of a better way of saying it, that spending you're going to need in 5 years when you start retiring. And bonds and money market account are the tools that you use to achieve that.
So if we talk about stocks and bonds as the tools, sometimes people have this perception that stocks are risky. They think of it as, well, I worked really hard for my money. Why would I put my money in something that could lose its value? Stocks can go up, but they can go down. So maybe a question for Stuart then is, how do people think about that risk? There is some risk in investing in stocks as opposed to bonds. So how do you interpret that, or how do you explain?
This is something, Rob and I talk about constantly. I think there is a very widespread misunderstanding of risk when it comes to investing. And what you said, Cecile, is spot on. If you read the stuff online or listen to the news or whatever, and you hear people talking about stocks, you always hear it in the context of stocks are risky, stocks are risky. And the reason is because over a 1 year short-term period, they are risky. You could lose a lot of money. Just earlier this year, the stock market, the S&P 500, dropped like 34% in a very short period of time. Now it's come back since then, but it's a heck of a roller coaster ride. It's extremely stressful. One of the things that we tried to get across in the weekly investment challenge is the idea of always having some sort of context when you talk about risk, because risk over 1 year, as Rob was just talking about, is completely different than risk over 40 years. So to make this as simple as I can, the reason Rob said 100% stocks over a 40-year period is because we have literally never, ever had a 40-year period in which the worst performance on stocks was lower than the best performance on a money market fund. It's not even close. So the trick, and this is where it kind of gets into all the psychology stuff as well, is how do you, if you're looking at money you're not going to need for 30, 40 years from now, how do you keep yourself from overreacting to all the talk you hear, the short-term risk and so forth? And that's part of the education that Rob was talking about, that you have to understand that. But for most of the time that your students are investing, most of their investment life, stocks will literally be the least risky investment that they could possibly buy. Because over time, you know, you have the ups and downs, but you end up significantly ahead. I would say the biggest mistake I see younger investors make is they are too, quote unquote, conservative. And what I would like to see is for everybody to start actually, I guess, being a little more intelligent about the way we use the term risk. So you'll see a lot of times where people talk about, well, if your risk tolerance can handle it, you can get into risky stocks and so forth, and they'll work out over the long term. I think it's more appropriate to say, if you're investing for the long term, you ought to get into something less risky like stocks, because it literally is less risky. But that's all part of, and a lot of this is why I'm really interested in the psychology of all this stuff, and why I like working with you on this, because I think there's, and we didn't used to do this. I mean, everybody, like, you wouldn't talk about how people think about stuff, but now it's becoming more mainstream, which is why I think I said last time, I think there are opportunities for jobs in this arena. But yeah, I mean, I think that's challenging, but I think most people get it wrong most of the time.
So that leads me to my next, but also last question. So historically, you know, the financial industry, but also the data suggests that, you know, women, underrepresented minorities tend to not be likely to invest in stocks. They tend to think of them as risky, and so they shy away from investing in stocks. You know, and that hasn't even changed. You know, women tend to be more likely to be high income earners. They are more likely to be responsible for a household. But the investment in stocks, and it's not just in the United States, around the world, they tend not to invest in stocks. So I guess my question, maybe I'll direct this to Rob, because he works in the with people every day, is that why is financial education important for everyone? And you know, how can we make it more appealing for other folks to get involved in investing in stocks?
Great question. And a lot of it has to do with understanding how investments weather long-term situations. And that's all types of investing. So it's education at the end of the day that's going to help people through this process. And it's reading. You've got to educate yourself. You've got to be willing to dig in and learn on your own, and then ask questions. There are multiple resources online that you can have access to. There's professionals like myself. There's professors at universities. If you're a student there, hey, I'd go find time to talk to a finance professor and educate myself a little bit more. Educate myself by talking to others. And then that's through osmosis. As you learn something, maybe you give them something. At the end of the day, it is education. It doesn't mean that you'll be the one who manages the money. I always talk to clients, and there are some very smart people that I deal with. But at the end of the day, there's one or two variables, or maybe one of the three variables, that they just don't want to do, and I call it, do they have the time to do the research? Do they have the talent to actually analyze and make sure that it's where they want to go? And I would say that's an easy one to overcome, because through indexing, you can capture 90% of what you need to capture to get where you need to be. And then most importantly, and this is something Stuart and you and I, we talk about all the time, is the temperament. And that's the psychology. You've got to be willing to understand that. Stuart, you gave a great example this year. I invested $1,000 at the beginning of the year. It went down to $660 as of March 23rd or 24th. I can't remember the exact date, but it's one of those two dates where it dropped. Do I have the temperament to now just understand that this was a long-term investment and that I can ride out this storm? So it takes more than just knowledge. It does take what I'll say is an internal understanding that you've got to be able to be strong and fortified to be able to run and face those challenges of a down market. I look back over the last 20 years, we had 2000, 2001, 2003. The market went down, Stuart, 37%, maybe a little bit more in total.
Yeah.
Okay. You had 2007 through 2009, where the market went down 51%, roughly speaking.
Yeah.
And then this year alone, the market went down 35. But let's look what happened. Each time it's recovered. And people need to remember, after every big drop, the market has corrected 100% of the time and gone up above. It's never failed to recover and go above where it was. It might take some time.
What you just said is pretty significant. So like people talk about bear markets all the time, where the stock market drops 20% or more. And what you just said was literally every single bear market we've ever had, the stock market has recovered 100% of the time and gone on to post significantly, higher returns.
New highs.
Yeah,
exactly. Stuart, and you can help me. We've talked about this over the last year or two, because the market has done pretty well for a protracted time period. This has been the second longest bull market before the pandemic hit.
Yeah.
People were very nervous, and they were thinking, when is the next correction coming? And it's got to come because we've had such new highs. Well, if I remember correctly, the market makes new highs 61% of the times each year.
It's like historically, when you see a headline like, oh my, the stock market just hit a new high, and the implication is, well, should we be worried? Well, that's what happens most of the time. It's normal for stock markets to hit new highs. But Cecile, I've got a question for you, if you can answer real quick, because what we just been talking about relates to more than just investing.
Yes.
This whole idea of what tools are there from a psychological standpoint to help you not get stressed out about whatever it happens to be in the short run, when I guess more rationally, this will work out over longer periods of time.
Yeah, so this is what the students are actually reading the same week they're going to watch this video. So we're talking a lot about optimal decisions and how, when you make a decision, you want to make sure that you're thinking carefully about what the end goal is, and making sure that the decision is consistent with that end goal, and making sure that you're not allowing emotions, whether positive or negative, to interfere with that decision process. Because, fear, we talked about fear drives decisions, but a lot of times that derails you off a decision that keeps you aligned to your end goal. But also optimistically, so, I'm sure this happens with, in investing all the time too, is that, stock keeps going up and up and up and up, and everyone gets really elated and happy, and they feel like this is a never ending, runaway train to being the richest person in the world. But the reality is that, there's a certain glide path of what stocks are probably going to make over the long term. And so whether you're overly happy about something or really fearful about something, you're probably not thinking about the decisions in the most optimal way and keeping that end goal in mind. that's when you're really an optimal decision maker. But it's not easy to do. And it's, as humans, we tend to be driven by emotions more than we should. So the people who can acknowledge the emotions, like to acknowledge that they're there, is good, because then you can say, you know what, I'm really fearful right now. The stock market just dropped this huge amount. I acknowledge that, but on the other hand, my end goal is still not, until 40 years from now. So I'm not going to worry about it. I still am exactly where I want to be. So yeah. And it's not just like, it's with all decisions, like, what's your end goal with your career or your personal life or anything else. A lot of those same decision processes, you want to think about your end game, what's the end goal, and yeah. So it's very interesting. I think also, when we think about the people who aren't participating, I think that's a great equalizing force in society if we get them to participate. So I know a lot of times, Stuart, you worked with NFL football players. They have a lot of money. We think that it solves all their problems, and then someone who doesn't have any money says, well, I can't participate in buying stocks because, I just don't have any money. But you all have experiences of people on both sides of the spectrum. They were not making a lot of money, but they were very careful, good investors. They ended up having a very comfortable retirement, and vice versa. I think that's probably why you started working with the football players, right?
Well, yeah, well, I mean, part of it was, well, like anybody else that's, just coming out of college or whatever, you haven't had any exposure to this for most people. In a lot of cases, there's you start out with a lack of trust, which is, I mean, to me, the biggest factor in investing is time because of the compounding. But the biggest determinant of success is confidence. If you're confident in the game plan, like if you're working with somebody with Rob and they can like explain it to you very clearly and so forth, and you can be confident about it so that you're not worrying about it. So when, the next time we have, who knows? I mean, it could happen again soon, market goes down. If you're doing it right, investing should be pretty boring because it's just, it plays out over a long period of time and you just have to be confident it's going to work out. I guess if I were to make an analogy with and we do this a lot with the NFL guys, is a year in the stock market might be like a single play in a football game. Okay, so you don't, and they understand that you don't get sacked or tackled for a loss and then just panic and walk off the field and so forth. You're looking at how you can do over the course of a game and so forth. You just get up and kind of make the next play. And it's the ones that are really successful are the ones that can put those negative plays, immediately in, behind them and move forward. So, I mean, a lot of this stuff, like you were saying, Cecile, it's not just with money or investing, it's with every decision you make. But I do think that because of all the tools that can be brought to bear from a psychological standpoint, that we're finally, starting to see acceptance of that when it comes to talking about money. It's not, the assumption before was everybody's rational. Now we're realizing like nobody's rational.
Yeah. And that's a great ending point, because I think that's true that once we acknowledge that we're not really rational, then we can make choices to help us do a better job. And then also talking about money and learning about it will allow us to do a whole bunch of great things and allow you to have more confidence to delve into this area. So I think you have to be curious about it first. And then once you start getting curious, then you start researching and learning, and then you get more confident, and yeah. And then it's like great things happen. So, well, thank you both. This has been great. I really appreciate you joining us again. And I will allow the students to post questions or anything in class. So thank you both.
Well, you're welcome. Thanks for having us.
Thank you very much.